Hello, hello, everyone. Welcome back to the Weekend Charts. Charlie Bilello here today. Special guest. I think this is the third time you've been on. Jamie Battmer. He's the Chief Investment Officer at Creative Planning. How's it going, Jamie? Welcome back to the show.
Hey Charlie, thanks for having me back. Really appreciate it. You look great for your advancing age. So happy to be back, third
I,
time.
I appreciate it. And you as well. I like that shirt. You know, the last two, I think you had sports themes. Now you're just going, classic shirt, getting ready for the summer. Looks like we're ready to go here. So I want to go through the docket here. The cumulative versus current inflation debate. So we got a little bit of interesting CPI data. You and I can go through that. The employment data last week, I want to talk about that, and perhaps is the rising unemployment rate signaling a recession? I'll show you some interesting data and get your take. Powell, I'm going to say he might be watching the weekend charts, Jamie, because he's starting to come around to my line of thinking, which is no rush in terms of needing to cut right now. Let's just wait and see.
Yeah.
Things are going okay, and this whole concept of we're going to cut 6, 7 times this year, that's been completely thrown out. How about this? The best start to a presidential election year ever. I'm going to run through the data there. Nobody had that on their bingo card, but I'm glad it's happening because I know you talk to clients all the time about this and that they shouldn't be changing their portfolio based on the presidential election. So nice to see markets doing well. Some secular trends really getting stretched. This has kind of been a theme year after year for the last decade, but now in my view, at least, we're starting to see these things get stretched. And I'll talk about what I'm discussing there. And that's going to be large caps and small caps and growth and value and US and international, those being the big three. And we'll end, as we always do, with the path to prosperity, some good news coming out of the inflation and employment report. So let's dig in, start out with the cumulative versus current inflation debate. I'm going to set it up here in terms of this is what the data we got this week. It was a little bit better than expected. Markets seemed to like that. The headline expectation was 3.5% for CPI, came in headline was 3.4%, came in at 3.3, and core expectation 3.5 came in at 3.4. And that 0.1%, Jamie, for some reason, seemed to get everyone excited. Before I go into some of the details of the report, what do you make of this trend here? It was the lowest core CPI reading since April 2021.
Yeah, these fraction of percentage point differences and how they can have these massive gyrations for markets is just seems crazy to me. I think most importantly, just the trend line, like anything. It's not if things are good or bad, or are they getting worse or are they getting better? And the trend line has been we are moving in the right direction coming out of the huge spike, brought on by COVID and all the related dynamics there, not to get into that. But yeah, a 0.1 difference, 0.2 difference that really shouldn't have the power it does. Just like some of the comments that come out of these pearly towers shouldn't have the power they do, but we like the overall trend line and take that as a really, really positive thing.
For sure. So we're seeing that you see that spike there, 9.1%. That was in June 2022. And what a difference today versus back then, right? Back then, you had gas prices, you had everything, utilities, everything going up on a year over year basis and going up by huge amounts. You fast forward to today, and with the exception of transportation, all of the major categories have a lower rate of inflation than they did back then, and some of them are outright negative. You look at used cars and new cars down over the last year, and we'll talk about this later. But food prices, finally, the inflation there is coming down to 1% over the last year, so very good news. Now, if we look at the most important factor in CPI, and this is a huge one, it's over a third of the index. That would be shelter. And what what stands out in this chart when you look at it, Jamie, is the real time data is showing rent prices that are down year over year, and we've seen that for over 12 months now, where we've seen negative year over year prices. But shelter CPI still elevated at 5.4%, coming down every month. But this is the big reason why inflation is still north of 3%. And I always ask the question, like, should we be trying to reflect more real-time inflation data? The way they do it now is they're asking people what their houses would be renting out for, and they're looking at leases that are rolling off. So those leases from a few years ago, that didn't have price increases, well, now they're getting those price increases today. So the real time rents are showing what people are asking for right now versus shelter CPI, which, as you can see here, very lagging indicator. The good news is, if as long as rents stay low, it's this likely to trend lower, which means that core CPI number pretty much very likely is to continue to trend lower in the coming months. But what do you make of, should we be using shelter CPI? Such a big component. Should we be calculating it the way we are?
Yeah, a lot of these things, they're just educated guesses. In some capacities, some of them aren't even that educated, or it's a really small sample set, or they're only calling people that have landlines, right? Talk about kind of cornering yourself into a certain dynamic. And so always looking to kind of evolve these things to make them more accurate, a more fair representation of the economy instead of just again, including people that have landlines is a positive thing, because again, it can just be very, very misleading. It distorts the numbers on a short-term basis. And like you talked about, people were dancing in the streets over inflation coming in 0.1% lower than what the anticipation was. When you've got this kind of inaccurate information, it always needs to be improved upon. Get a more, good data in, good data out, expand the sample size, make it more inclusive, make it more, factoring in kind of what is making these data points hum now, and it's a positive. All I know is, hey, it's expensive to rent in the United States. What this data says. We've actually seen interesting retirees just reading. There's a lot of people moving to Italy. Yes, there's great things about Italy, the food, the wine, but also, living in an apartment costs about 45% less on average in the United States. So that's the real data. People are, voting with their feet, and the data points we're using have to continually update to try and be fair. But more so, just people shouldn't overreact to how these inaccurate data points reflect these headline numbers that get people overly excited or overly fearful. It's all short-term noise and should primarily be ignored.
Yeah, and there's a difference between the stock market's reaction and investor reaction and the average person's reaction, because the average person is still feeling very much the inflation because they're looking at cumulative inflation. They're not saying, "Oh, this is wonderful because CPI is now increased 3.3% over the last year." They're saying, "Well, for 3 straight years now, we've had above 3% inflation." And if we look at the last 4 years, we look at the cumulative increases in some of these categories, everything from home prices up 47%, gas prices up 90%, electricity 30%, food away from home, looking at restaurants 25%, grocery prices 20%. That's the number they've been focusing on. And so if you look at the polls and you look at the polls of investors and saying, how do you feel about the economy and how do you feel about the current situation in terms of, is things getting better in your household or worse? I think the reason why the polls haven't been reflecting what the stock market's been reflecting is because of this very reason, that cumulative inflation. Does that make sense in terms of trying to explain why is consumer sentiment, Jamie, still so low? Why are a number of people, there was a recent Harris poll where more than half of the respondents said the U.S. economy is in a recession today. The only way I could explain that is because of this inflation picture, in terms of they really don't like the fact that prices are up 20 to 30% cumulatively over the past few years.
Yeah, I mean, people look at it in longer term. That, hey, I'm not excited that bacon now costs me only 30 cents more. Over the last 5 years, it's costing me 50% more. And so, actually, it hurts everyone in real time, all the time. And really, kind of a perfect example of this is, it's also kind of an excise tax on people in lower kind of socioeconomic standing. Because again, home prices going up, stock prices going up. These are people that they're able to own things are benefiting from this, right? If you own stocks, they're going up. You own a home, over time, they're going up. But again, on the flip side of that, it makes it kind of less available for a larger swath of the population. And that's unfortunate. So it just
It's
reinforces,
a it's a tale of two cities. What is what you're
yeah,
saying? There's some people
yeah,
who this has been very beneficial, and that's the catch 22, Jamie. Because like if housing is the biggest factor, and it is for most households, whether you're renting or you own a home and it's your mortgage payment and everything else, if that's the biggest factor, and you want inflation to come down, well, all of the existing asset owners, they might not be happy about home prices coming back down again, right? That wealth effect, which I could debate whether it's actually good in the long run in terms of increasing economic growth, but there's no question there's an impact psychologically for people, and they feel better when their home is up 40% in the last 4 years. And are they really going to get on board with policies which in my mind would just mean letting the free market go to work, stop the Fed from buying mortgage bonds, don't be in a rush to cut interest rates here? Do they really want to go through another period where we saw home prices go down from 2007 to 2012 over 25% nationally? Are they going to just sit there and accept that, even though that would be very good for inflation, very good for new home buyers, probably good for the economy in the long run because you're not spending so much in this resource of housing. You're able to invest in other areas that are more productive and exportable. But are people going to be on board when that's the biggest asset that most people have in terms of their net worth?
yeah. There's always the yin to the yang, and it's impacting different people in different ways. It just reinforces the benefit of of owning things and trying to make that a part of your life. And and so those that are fortunate enough to be in that circumstance can benefit from it, and it impacts everyone differently. One thing I do want to say, Charlie, on this is that the recent inflation, while no one likes it, having to pay more at the pump, pay more at the grocery store, it has kind of solved a couple kind of market anomalies that just to someone, you know, born and bred, born and raised, Missouri farm hayseed, it was hard for me to understand. There was an element, there was a time there when used cars cost more than new cars. I'm not talking about like a cool 1969 Toyota Land Cruiser. I'm talking about just a basic used car will actually cost more than a new car. That was just hard for me to understand. So there was this kind of weird dislocation that occurred. And then another thing that was very difficult is just the concept of negative interest rates, right? I'm the lend money to you, Charlie, and I'm gonna give you a little bit more money all the time for the benefit of lending money to you. It's just really kind of hard to understand. And that was the case. At one point, there was a tremendous amount of global debt that was yielding negative interest rates. Kind of some of these moves higher at least have kind of eliminated some of those just basic laws of financial gravity dynamics from the market. And so while overall we hate to see people having to pay more for things, there are like you said there are some positives to it as well.
Okay, positive side to inflation. I haven't heard that argument, JB, but there's a first time for everything. This is the
Yeah.
chart I keep focusing on when it comes to inflation, and we'll talk about the Fed in a little bit. But this is the idea that if we get back to 2% inflation, you and I have discussed this on the last show, I think, that doesn't mean that inflation has averaged 2%. And so we're 11% above where prices would have been had we been following a 2% trend since the beginning of 2020. And even if we get back to 2%, which hopefully we will, that doesn't erase that. And so, like in people's minds, this I think is the big disconnect. They don't like inflation because for a lot of people who, especially those who don't have assets, they're worried that their wages aren't going to keep up with that. And I think that was a valid concern. And we'll end with something positive on that front. But this is why, in my mind, the Fed has to stick to their guns here and don't cut interest rates. But I want to save that for anybody who's worried about inflation, thinking about inflation. You should be. We could debate inflation all day long, but the one thing I can pretty much guarantee you is that prices will be higher 20 years, 30 years from now than today. How much higher, no one knows. And your portfolio needs to be able to benefit from that. How do you benefit from that? You're investing in asset classes like stocks that have shown historically over 20, 30-year periods of time that they've not only kept pace with inflation, but outpaced it. So reach out for a free wealth path analysis. Is something new that we're offering all weekend charts viewers. I'll have a link in the show notes. Creative planning creativeplanning.com/Charlie. What do you get with that? Well, you get a lot. You get a free portfolio checkup. You get a free retirement roadmap. Are you on the right path? Tax planning. We have a ton of CPAs that do a great job at creative planning, and they'll go through everything in your portfolio and look to try to optimize in terms of tax planning. Are you holding bonds in the right area, stocks in the right area? Should you be doing a Roth conversion, things like that? And lastly, the estate plan. Don't forget about that. We have a number of great estate planning attorneys that will go through everything and make sure your affairs are in order. So reach out today. Creative Planning. We're in all 50 states, 300 billion plus in assets under management and advisement. Creativeplanning.com/Charlie. All right, Jamie, I want to talk about the employment report and get your take on this question here. Is rising unemployment signaling recession? But first, what do we see in that employment report? Better than expected jobs, and never want to put a lot of emphasis in any jobs report because there's huge revisions to these numbers, and that's another thing that people overreact to. Speaking of, 0.1% difference in CPI. Well, if this is a little bit higher, a little bit lower, everybody makes a big deal about it, and then the next month it's revised and no one talks about it. So here we have 272,000 jobs. I think that was 100,000 jobs better than the estimate. It's the 41st consecutive month of positive jobs growth. Pretty good here. You can see, other than that 100-month run there, that's getting to the point where it might be number two if we're going on another 6 to 8 months from now. It's going to be number two on this list. But here's the flip side. Unemployment rate ticked up to 4%. That ended a streak of 27 consecutive months below it, which was the longest since the late 1960s. And here are some signs. Labor market is cooling beyond the unemployment rate. We have job growth 1.8% year over year, slowest that we've seen in some time. The percentage of workers that are quitting their job down to 2.2%. That's back to pre-COVID levels. And job openings, which we had a ton of, a record number. If you look at the ratio of job openings to unemployed people, well, that's down to 1.2 and getting close to pre-COVID levels as well. What's your breakdown, Jamie, before I get to that question about the unemployment? What's your breakdown? Anything insightful here about the jobs market other than that it seems to be loosening, it seems to be healing, people are coming back to the labor force, they're coming back to work after that huge COVID distortion, and it's just a more normal market in terms of supply and demand?
Yeah, I mean, COVID was that just bolt of lightning. I almost think you just have to group those two kind of subsets together, that we're just, structurally in a very, very, very strong jobs market. I mean, a historically unprecedentedly strong jobs market. And really, that just kind of shifts back to, demographics, and demographics being destiny. You got a lot of people that have worked their tails off for a long time, kind of nearing retirement, in retirement, and they have money they want to spend. They want to go sit in the restaurant. They don't want to go work in the restaurant. And so again, as we kind of transition that, having fewer kids, it's just jobs are out there. And while maybe the unemployment rate might tick up, or it's slightly here, slightly there, you just overall, very, very, very strong jobs market. Again, we've got that dynamic of a really healthy, a healthier aging economic force with baby boomers kind of driving all kind of these the demand for these service level jobs. And then really all kind of the excitement with new technology. Understand, people can pop out and be an Uber driver in real time, right? The ability to grab a job on the fly is just amazingly more efficient than it used to be. So the jobs market, just continues to be strong. We just take that as a very, very positive sign. And while it could be disrupted at any moment, like it was with the COVID calamity, just overall kind of the structural dynamic of our economy just lends itself to being really, really favorable for a continually strong and robust jobs market.
Yeah, for sure. Hopefully it will continue here. And just because we're back to where we were before doesn't mean it has to end in terms of jobs growth. And the way I look at supply and demand for labor, these two charts clearly illustrate people are more hesitant to leave their job, right? They were quitting their jobs at record rates because there were so many jobs available. They could switch and get a better job, higher pay, something they would rather be doing, right? So that was a great thing for people. And you saw a lot of polls suggesting people were happier in their jobs than they've ever been. But this is the key chart in terms for me in terms of supply and demand. If this continues to trend lower, it will likely mean the employer is starting to get the upper hand. But still, to me, we're still going to have 4% increase in hourly earnings over the last year. That's very strong. That means we still have, in my mind, demand for labor outpacing supply. But here's my big question for you, Jamie. We have the unemployment rate moving from 3.4%, which was the lowest since the 1960s. That was last year, April 2023. Fast forward to today, in May 2024, we're up to 4%. So I look back historically, these are all the times from a low in a cycle that the unemployment rate has increased 0.6%. And then I looked at how much time between that happening and a recession starting. You can see over here in the last, maybe 10 times, almost every time it's been either that month or a month or two in either direction. And you have to go back really 45 to 48 period expansion to find a really longer lag there. Do you make anything of this, or do you think the famous words "this time is different" should be applied here?
Well, we know a recession's coming. We just don't know when it's gonna come. Maybe it could be the average of this, or maybe it could be, 10 years from now. But really overall, I just think there's more to it. This time is not different. It's never really that different. But the idea, it was really interesting, some dynamics, and it definitely impacted different demographics differently. But this just huge element of people just no longer considering themselves a part of the labor force. That really kind of ramped up in the global financial crisis of '08. Because interestingly, it was really a disproportionately high impact on working age men, right? As a percentage of the labor force pool, made those employed or those looking for gainful employment really started to decline. And so in a way, you can say, well, yes, ticking up unemployment rate is challenging, but what's it showing? It's actually showing, based on demographics, that more people are kind of stepping back into saying, throwing their hat in the ring, wanting to get back in there. And, you get people engaged, you get people working, you get them inspired, you get them, moving forward, I take that as a positive thing. So it's interesting. I would not have guessed this, that on average, we're there or we're about to be there, or heck, it's already happened. But again, recessions are just an inevitable byproduct of markets, of the economy, and we build our portfolios to be recession proof or not be modified because of recession. And I see that no different here. But that's a very interesting chart. I wasn't
Yeah,
aware of
it's
that, Probably.
it's hard to say. It's hard to make the argument. Let's say, James, we're looking at the totality of data to say we're in a recession today, right? I mean, we have the inverted yield curve that's been going on for a few years. We talked about that, and we have some signs of retail sales slowing, but with the fiscal stimulus, in my view, still so high, and the employment picture overall still trending positive. It doesn't seem like we're in it today. Now that could change very quickly, right? Like it did back in 2007, 2020. I think you just kind of have to throw it out, right? Because it's an extreme example. But here and now, it'll be hard, I think, to make that case. And this is where I would say this time is kind of different. The fact that so many people left the labor force and haven't come back after that COVID period. Either many of this is, Jamie, people retiring early, and you've probably spoken to a number of people, clients at Creative Planning who are in this situation. This was an unexpected byproduct of this because we had such a huge increase in asset prices during this period of time that these retirees were able to retire earlier, and they haven't come back so far. We saw a little bit of them coming back in 2022 when stocks went down and there was fears that home prices would go down and inflation was so high. But in 2023, the data so far has showed that that has reversed. And if we look at this year, we'll talk about the stock market in a little bit and how it's doing. But we're not seeing signs that they're coming back, right? So we still have this about 4 million gap between the number of jobs that we would have had in the economy had that pre-COVID trend just continued and where we are today. So this means likely that payroll gains are going to continue, likely wage increases are going to continue. Pretty hard to have a recession when that's the case.
Yeah. Again, it's amazing, these shocks that happen, they dislocate things, COVID, global financial crisis, dot-com bubble bursting, World War II, World War One, whatever, cavemen throwing rocks at each other. There's always something that's going to impact the trend. But what you see here, it's the gap is closing. The trend line is, yeah, there's 4 million less workers than we should have. But hopefully we can continue to make progress there.
Yeah, and every industry is different. I mean, healthcare has continued to be the number one sector in terms of adding jobs pretty much every month over the last year, and that saw a huge dropout during COVID, and now finally every month they're replacing, and that's a secular trend that surely with the aging baby boomer population, we're going to need more healthcare workers, and that's so it's all dependent, right? Whereas the tech industry, we've seen much slower job growth. They hired a lot in 2020, 2021, and now they're kind of pulling back, right? So every industry is different, but overall, still expect job growth continue for at least a few more months. We got to shift gears, talk about the Fed. I think Jerome Powell might be watching the show, and that's because he's coming around to my line of thinking here. Last December, very different tune from Powell. Everyone got excited because he was suggesting the Fed might cut rates 3 times. You and I said a few months ago they shouldn't do it in June. They didn't do it in June, and if they updated their projections, Jamie, and now they're saying that they're according to their projections, and they don't have to hold to this as we know. They could change them again in a few months. They're only going to cut 1 time this year, and the market is expecting that cut to occur in September. Did you watch any of the press conference from Powell? And was any of this a surprise to me? Not really much of a surprise at all. They're just reacting to the data that we just talked about. That inflation still remains, even though it's come down and it's likely to continue to go lower, still well above that 2% target.
Yeah, I didn't listen to it. I mean, people that listen to that for changing is to was or then to that, it's crazy how much focus is on these few individuals, because all this does is highlight for us, Charlie, kind of the core of the creative plan mandate is everyone's crystal ball is just as effective as anyone else's, and the answer is it's not effective at all. So these are kind of some of the most powerful people in the world in regards to finance. And now I don't have such like a Jacksonian passion to make changes to the Fed as you, Charlie. But again, they said these people that can kind of turn the levers. If anyone could create self-fulfilling prophecies more, it should be these very powerful people. They got it wrong, right? But then even the people, the Wall Street economist crowd, right? They were saying, no. These super powerful people, we're smarter than them. Our crystal ball is better than theirs. They're super undercutting it. We're going to have 6 to 7.
They were even
not
worse,
only wrong,
much
they
worse.
were more wrong than the Fed.
Yeah.
And so the idea is, it ebbs and flows. It's data dependent. You and I talked about it. We didn't know it was going to happen, but hey, at that point, the economy seems strong. Why waste this ammunition now? Why create unnecessary stimulus?
Stock prices at record highs, home prices at record highs, employment still moving in the right direction, and you still have elevated inflation. To me, that wasn't a formula for cutting rates 3 times, or definitely not 6 times. But as you said, all this can change, right? As the data comes in, they'll change. I think they want to cut rates. I think they would love to cut rates. They just don't want to be looking foolish, let's say, if inflation starts ticking up again. But I think the big thing here, Jamie, is look at that longer run inflation. Like they're moving, they're coming around to the idea that we're not going back to that 0% rate scenario that you talked about earlier, which I think is a benefit of this happening. They're kind of saying, for now at least, let's not go right back to that ultra easy policy, and I think that ultimately is a good thing. And this projection will change here. If we look where the Fed funds rate is relative to core PCE, monetary policy is tight, but it's only been tight for a little over a year. So my argument's been, let it do its work. Let it do a little bit more work. We finally have new car prices coming down. We're seeing the housing activity obviously stay low. If you cut rates here, all of that's going to change, right? And so if you really want to bring inflation down, let it do its work. And this would be the only reason, Jamie, I could foresee why the Fed might want to cut rates before inflation comes down. We got another record high in terms of the interest we're paying on national debt, which is very quickly approaching 35 trillion, 1.08 trillion over the past year interest expense. And if it continues on this pace, it's going to become the biggest line item in the budget, surpassing Social Security. Do you think this is factoring in at all to their decisions and saying we can't keep rates very high for very long, or this is going to become a real problem?
Yeah, if anyone has problems sleeping at night, I can send you my master's degree dissertation, which was actually on the relationship between the Federal Reserve and the Treasury. They really are designed to be independent, and people can argue they are or not. Politicians love blaming them for their ills. Jimmy Carter blamed the last assault on inflation for him not being elected. Richard Nixon blamed the Fed for the fact that he lost to Kennedy in '60. So the blame game comes on both sides of the political aisle. And yeah, I mean, we higher interest rates on the massive amount of debt we create. Yeah, that makes it more of a burden, a larger line item. And so you hope that they could, the political pressure remains on the side, because again, that's more, what's that driving you to? That's driving you to the short termism, right? They want to look good for the next election, or drive that down. Get inflation under control and let's move on. Let's get low interest rates lower. People will be happier. Let's move on. No, again, just like how we look at things, success is measured in decades, not days, not quarters, not years. And you hope that'll change. But unfortunately, it's been the decades of onerous amounts of debt expansion that's putting us problem. Again, it's been covered up by the fact that interest rates have been so low for so long. And so if anything, maybe that will open up people's eyes to the fiscal imprudence of some of these decisions. So yeah, it will come home to roost. I hope it doesn't put a unnecessary debt burden on my three kids, on any of our kids. But it's a
It's
problem. But you'd
it's
hope there's still
there.
not that
I
political
mean,
pressure.
yeah, it's hard to say that it won't, right? It's there. Someone's gonna have to pay it. For now, we just kick the can. I don't. When I look at this chart, Jamie, it seems extreme, but I don't think this is nearly high enough for people to be viewing this as such a huge issue that they're going to act on it. Like,
Yeah.
especially in an election year, spending is going to continue, right, for the next few months. You're not going to be, not on my watch. You're not going to, now's not the time to pull back, right? In
Yeah.
terms of if you want to get reelected, you're gonna continue to spend. And here's the big disconnect in terms of central bank policy and inflation here. So the U.S. we're at 3.3%. We've got the eurozone at 2.6% inflation. Canada at 2.7%, a little bit lower. But these banks just recently started their cutting cycle, right? We got ECB, not a lot. They cut a quarter point. Bank of Canada cuts a quarter point. And the impact that's having, of course, is on currencies, right? If we look at the euro, we look at the yen is barely, I mean, the Bank of Japan just barely moved rates back into positive territory. So, and the Fed says, and someone asked Powell about this, about the strong dollar, and his statement is always, "Oh, we don't look at the dollar. That's not that's not within our mandate." But you have to think that they're starting to look at this kind of disconnect, and if these banks continue to cut rates, I think that'll be an additional pressure for the Fed, especially if we can. I like a strong dollar, but a lot of people in that academic world say if the dollar's too strong, that's a bad thing. And I think this might be pushing the Fed, let's say, his hand to cut as well at some point this year. Do you put any credence on that?
Yeah, birds of a feather usually flock together. I mean, you'll see a lot of the people that are cutting rates, their economies aren't continuing to plow forward like ours, right? So they're
Yeah,
saying,
good
okay,
point. Good point.
we're,
Yeah.
but typically they do, the trend lines typically tend to move together. So maybe it will put some pressure on there, but let's hopefully let the data drive the decision making. And if you have to, if you think you have to stimulate your economy because it's petering out, great. But if the economy is continuing to plow forward, don't do it.
So we're in a different situation. Just and take that strong dollar. Guess what? A strong dollar actually helps inflation, right? Makes your imports cheaper. So not the worst thing in my mind to have a strong dollar. And what the Bank of Japan doing is a grand experiment, but if manipulating things to this extent, in terms of the interest rates and what they've been doing in terms of buying pretty much all of the issuance that in terms of new debt. To me, not a good thing, not a model for us to follow. But I want to talk about markets and secular trends very quickly here, Jamie. This has been an awesome year. So we showed this chart the last time you are, but the numbers have grown. 28 all-time highs. S&P 500 hitting, going above 5,400 for the first time ever this week, and you can just see the milestones piling up here over the past few months. We talked about this chart the last time, but now we're ahead of every strategist forecast entering the year. We're actually 12% above the average forecast, and we're not even halfway through the year. And thank goodness I am a strategist technically. Thank goodness I don't play this game of forecasting.
Mhm.
And whoever was at JP Morgan, I don't know that person's name, but I'm sure they've by now revised that much higher. And so certainly you don't want to be playing this game. But here's the chart here. The best performance in a presidential election year, best start to a year through 113 trading days ever, 13.7% gain for the S&P 500. I know you talk to a lot of clients, and I'm sure the election has come up, and our message at Creative Planning has been, please, all year, do not trade based on the election. And it's kind of nice that this is the situation we're in, because much harder to make that argument, let's say if we were down 13% than being up 13%.
Yeah, we always just say, the markets aren't red, they're not blue, they're green. And the economy, the markets are so much larger than any one political party. Yes, it gets us emotionally amped up. But as we know, emotionally amped up decision making in finance more often than not leads to poor decision making. And so the idea is stay invested, keep investing. If your particular pony doesn't win, you're free. And when people say I'm moving to Canada, if I think Canada is a beautiful place, feel free to go, but just keep your money invested. Don't take your money with you. And it's great that we have a great year. Going into election year, but again, that's a typical thing, regardless of political leanings. And we're just happy to see the markets continuing to trend positively.
Awesome. So secular trends here, Jamie. This is a huge one, and year after year, it's the same thing. We're waiting for a reversal in these, and every time it seems like there's going to be a reversal, it just snaps right back, and we go in that direction here. Small caps. I'm going to show you a few charts here. Small caps to large caps. Lowest new low for the IWM, the Russell 2000 ETF came out in May 2000. New relative low. After it came out, it was a great decade for small caps relative to large caps. Since then, it's given back all of those relative gains and more. We're at a new low for this ETF versus the S&P 500. Another way of looking at it is just looking at the performance of some of the biggest stocks here. Three largest companies in the world. You have Microsoft, Apple, Nvidia, for the first time ever, all above $3 trillion in market cap. And look at this. This is kind of studying the top three holdings in the S&P 500 now make up close to 21% of the index, a record high. Nothing comes even close. So that's kind of reinforcing that large versus small, and the big are getting bigger. And lastly, two more here. We got growth to value, highest since September 2000, right? So stocks like Nvidia obviously driving this along with some of the Mag 7 names, and US versus international, which is something we've talked about a lot. But look at this trend line over the last 15 years, up and to the right, another record high of late. I just threw a lot at you. Give me the 1 minute on, is this getting stretched? Is it to the point where you say this is just now too much? This is crazy in terms of the unrelenting move, and a lot of them have similar themes, right? Large cap, growth stock. What are the biggest large caps? Well, they're growth stocks, right? And what are the biggest part of the U.S. indices? Well, it's those large cap growth stocks, and that's why we're trouncing international. And then you have, of course, the strength in the dollar as well helping.
Yeah, there's a lot of factors at play. You'd assume when you're stretched like this, there'll be an inevitable reversion of the mean. But when that inevitably occurs, no one knows. The markets can be crazy a lot longer than you can be liquid, they say. And the key to this, Charlie, just for people to remember, again, measuring success in decades. If we were having the same conversation 15 years prior, it would have almost been the exact opposite, right?
Yeah, it would have been. Yeah.
Emerging markets were up 400% and the S&P 500 was up 0%,
The
over
bricks.
a
No one
10-year
talks about the
period.
bricks. Yeah.
Yeah, again, people, yeah, again, BRICS, Brazil, Russia, India, China. Think of how much that's changed. Bring up investing in Russia to someone right now and see what occurs there. So
You can't.
just like
It's
it,
out. The R is
yeah,
out. If
yeah,
you're a
it'd
U.S.
be
investor.
we didn't chase emerging markets then. We didn't chase international then. We didn't chase small caps then. You can't do the same thing now. Again, broadly own the market. Again, what's Amazon today was Apple before, ExxonMobil before that, Eastman Kodak, General Electric, General Motors. The names will change, and the ebbs and flow between big and small, international and domestic will forever change. That's why you want to be part of all of it. And so I think the key to these, massively pronounced charts again, it would have been the exact opposite if we were doing this when Charlie and I were both much, much younger. I would have been younger than him at that point still too. But again, you could absolutely flip the charts. And that's why you just don't chase the hot dots, own it all, ride all the waves, avoid the lack of diversification risk. And there typically is a reversion to mean, but no one knows when that's going to occur.
Yeah, the iron, as Jack Bogle said, the iron rule of financial markets is reversion to the mean, and so this will likely mean revert at some point. We just don't know when. And I want to end with something positive, as we always do. That would be the path to prosperity. What's the path to prosperity? Well, to me, it's very simple. It's your purchasing power going up over time. It's wages outpacing inflation. Best news out of the CPI report, Jamie, to me, was that food price inflation coming down, right? This is the biggest factor for a lot of low income Americans. Obviously, we've just seen crazy price increases over the past few years in groceries, restaurants. You and I talked about McDonald's and fast food and just the crazy price increases there. But good news here, we're down to 1% in terms of grocery prices over the last year, and food away from home down to 3.4%. Both of them lowest we've seen in a few years. And what this translates to for someone whose wages are going up 4% over the past years is an increase in prosperity. So now we have 13 consecutive months where hourly earnings on a year-over-year basis have outpaced inflation. So you got hourly earnings up 4.1%, inflation going up 3.3%. May not seem like a huge difference, Jamie, but you compound that over time, and that's been the story of prosperity over the last 100 years, 200 years. It's real income growth, real wage growth over time. And I can't think of a better trend that I'd love to see continue. I think it for sure will continue for another month. We'll likely have another pretty strong wage number next month. And we're expecting the CPI to maybe even fall a little bit for the next reading. And so this should continue, and hopefully everybody should be rooting for this to continue over the next decade.
Yeah, it's a great positive trend line. It's the path to prosperity over the long run. And then last chart you showed, it's a shame things are going up, but we're pack animals, and having the ability to have a reasonable meal at home with your family and loved ones, or meeting friends and family out, it's just a very common thing of centenarians out there that they get together. And so if that's making that more reasonable, or at least not making it less reasonable at an elevated relative rate, I see that as a great thing. But again, that's a long-term path to prosperity, is continuing kind of net positive trend line. And it's great that we've seen that here for quite some time.
Yeah, and I'll just put my last plug in here. This is yet another reason why we shouldn't be cutting rates, because we got to keep that inflation rate low and hopefully drive it lower. No reason to take the chance for it going higher. We want this to continue. We don't want to get back to this period of negative real wage growth, which was very harmful for Americans. So let's continue on the path to prosperity. Jamie, that was fun. We covered a lot of ground in a short period of time. Appreciate you coming on. And we'll see everyone next time on the Weekend Charts. Have a great weekend, everyone. Thanks for joining.
Yeah. Thanks, everyone. Thanks, Charlie.